Prashant Jain joins now. Always delight to get his thoughts, and especially at this turning point when the world seems to be in some kind of a panic mode. And Prashant has seen many of these cycles in his experience of managing money for over 30 years. Now he's seen even worse pain points: 2009, 11, 2008, 2020, and at a time when the price action is reminiscent of what has happened in 2020 and 2008. Are markets overreacting, or are markets not react, or our markets are yet to react? So, Mr. Jain, always a delight to have you on ET Now. Thank you for joining us. The kind of carnage what we've seen in last 3 or 4 days is reminiscent of what we've seen in 2008 and 2020. Even though the news flow is not that bad, the price action at a global level has been quite nasty.
Nikunj, I think you are right that the stock prices have come off quite sharply. I think India is pretty well placed, if you ask me, because India's exposure to US goods exports is insignificant. It is 2% of our GDP. And it is well known that our tariffs on relative to our key competitors like China, Vietnam are lower. So if at all, we are at marginally at an advantage. As a result of this, what is happening, the oil prices, the US 10-year yields, and dollar have fallen sharply. And each of which are positive for India. I don't think, I mean, we care a lot more about oil than the impact on 2% of our GDP. And as far as the markets are concerned, while short term is always uncertain, I think there were two large sources of supply in this market which have sharply moderated. One was the primary market. We are all aware that investors have lost considerable money on capital raising in last 6 months. So I think the appetite for has gone down dramatically. So you can see the primary market activity has come off maybe 70, 80, 90%. And I don't see that reviving in a hurry. So that source of supply of new stock is gone. I think FI selling has moderated considerably. It will moderate even further. The US markets are now underperforming other global markets after a very long time. So therefore, I feel that fund managers would look to rebalance their portfolios. And let us ignore what happened yesterday. That was a big development. But over next few weeks, I would expect even foreign flows should outflows should moderate sharply. Who knows? They may even become buyers. I think everyone knows that India is the world's one of the fastest growing economies. Our fundamentals have not been impacted. Our relative competitive position is improved. The fall in oil prices is clearly going to benefit us. And above all, I think the valuations have turned a lot more reasonable. India's Nifty is now trading close to 17 times calendar 26 earnings, which is reasonable even for a 10 to 12% earnings growth, which I feel is a realistic estimate. See, one thing which has changed sharply over last 1 or 2 years is the gap between India and US yields has collapsed. If you go back few years, this gap used to be 4 to 6%. Now it is running between 2 to 2.5%. I think that lowering of cost of capital is a big advantage, and equities over time, I think, will price that in. So I am constructive on large caps. However, our return expectations have to be realistic. I think 12 odd percent is a reasonable return for Nifty over 2 3 year period on a compounding basis. Small mid caps, I would still be extremely cautious. So let me stop here and for any follow up questions that you have.
Okay. You know, just to bring a point to our viewers that if anybody would have said 12% a year ago, it would have been considered as dull and boring. After the market sell-off, if somebody is saying projected returns could be 12% CAGR, that thing I think should be a welcome delight, so to speak. So I'll just summarize the first point, what you've just flagged up, just for the benefit of our viewers, and that's why we'll do the interview. Whatever you are saying, we'll start summarizing it, and then if I'm not summarizing it well, you can stop me. You're making a case that India is less affected. India historically does well when commodity prices are low. India does well when interest rates are coming down, and India does well when there is a little bit of problem in the world. So the setup for India, I think from a global standpoint, is commodity prices have come down, valuations have become decent, and interest rates globally and locally will come down. Let's move to part two. A lot of commentators globally are saying that, look, this is change of the globalization era. what has benefited the wealth effect in post-World War is this entire globalization. If that starts reversing, it could have irreparable damages, which we cannot fathom today.
You are right, Nikunj. And see, only time can answer that question, what impact it has. And clearly, the world has benefited from free trade and specialization. And so there is no denying that. But India, I mean, while that issue remains, which time will answer, but I think India is quite well placed. India's correlation with world GDP growth is the lowest across years. And why is that the case? Because two-thirds of our economy is consumption, and India is extremely low per capita income. Only 5% of homes have air conditioner. Only 3-4 people percent people fly. So our low income growth, our great demographics, our low income levels, great demographics, and so our level of consumption is extremely low, and that is why our variation in GDP growth and dependence on global GDP growth is extremely low. Second, India is not a good exporter of goods. We are a good exporter of services. Service exports are less volatile than goods exports. That is the second reason. And third, we are a commodities importer. So that again, uncertain economic times, it helps us. So net, I feel that while what is happening could be marginally negative for world economy, but our impact should be very minimal. Let me give you one more example. See, India's export share in manufacturing is so low that 80% or thereabouts of our growth in exports in goods should come from market share gains. At this low base, insignificant base, if you start relying on world GDP growth to grow your exports, that would mean we have failed. If you look at last 30 years, our software service industry has grown massively. You cannot recognize it how it was 30 years back and where are we today. How has it grown so much? It has grown almost entirely or 70-80% through market share gains. So I think India should do everything possible to increase its competitiveness. Government is alive to this opportunity. They are supporting the industry. Our demographics, lower costs, geopolitics, all of it is support manufacturing. So I think even manufacturing share will grow over time. Though we have to be realistic, unlike services where you can set up a GCC in 1 quarter or 2 quarters, to set up a factory for supply chains to change, it will take many years. So I think we should measure our success in manufacturing over years and decades and not over quarters. Yes.
Let me use last year's example, which is that there was election, government spending slowed down, and it knocked off a good 1% from India's GDP. Given that tariffs are at play, decision making will get delayed, and it will get delayed by 1 quarter, 2 quarter, who knows. When that will happen, could that have an impact on the aggregate earnings, aggregate growth, aggregate earnings view? Will that change? Are we in for very lackluster 2 quarters of no decision making, which could start hurting markets?
Slowdown in government spending has come back. So while it hurt us initially, but I think that has been made up, or balance should be made up even next year. See, the fact is what India is growing around 6% a year, and there will be some volatility around that. It could be because of government spending, it could be because of some sort of slowdown in consumption, it could be because of exports. So I think it is very tough to take or give precise forecast in the near term. The right way to look at India is that this economy should grow around 6% for many years to come. Our inflation is averaging around 4 to 5%, which means our nominal GDP is growing in low double digits. Our corporate profits have completely recovered. Corporate margins bottomed out around COVID at 1.5% of India's GDP, corporate profitability. Today we are at 5.5 or 6 odd percent. In my opinion, there is very little room in any meaningful sector for margins to move up. What that tells you is your corporate profit growth should also be about 10-12%. So I think that is the right way to look at it. year to year, some year profits may grow 5%, some year they may grow 15%, because there are sectors which earnings are volatile. For example, if you are a crude company, earnings can be extremely volatile. In a OMC, you can have inventory gains or inventory losses. There are some companies which have foreign footprint. Some things could change. There could be currency changes. So I think if you take a 3 year view, I think earnings should grow between 10 and 12%. And year to year, there can be greater volatility because of this few small but highly volatile sectors in the Nifty.
And post COVID, we saw a lot of storytelling started in this market. Atmanirbhar, manufacturing renaissance, renewables. What happens to that storytelling part of the market? Like you always said, the narrative market.
So I think it is true, Nikunj, that last few years were a narrative-driven market, and these narratives are correct. See, the challenge with this is that the real world takes 5, 10 years to change, but markets price that change as if it is going to happen tomorrow. So these are great initiatives, Bharat or PLI schemes, or so these are defense indigenization of defense supplies. These are right narratives, these are correct narratives. But if a stock goes up 10x, but the earnings are not growing 10x, if a stock goes up 5x. So I think stock markets typically overprice a narrative. It happened to technology in 2000. It happened to infrastructure in 2007. It happened to pharma in 2014. It has happened to these sectors now. Now, what made this even easier or bigger was the way new investors have grown in India. Pre-COVID, there were 3 crore unique demat accounts, roughly. Currently, there are 11 crore unique demat accounts. Now, that tells you clearly that these 8 crore investors, who are three-fourths of the market, do not have any experience of stock markets, of investing, of equities prior to COVID. So it was this is my guess. I have not done any research or survey on this, but I feel that it is very natural for a first time investors to start believing a narrative. And that is why you created an excess in these sectors, and not just in these sectors, even in small and mid caps. So what happened in COVID? If Nifty fell, let's say 30%, small mid caps fell a lot more. Let's say some stock fell 70%. It fell to 30 rupees. Now in the normalization phase, for a large cap, 70 is going to 100, which is 40% return. If a company in small mid cap is going from 30 to 100, it is 200% return. And if you have joined the market around that time, you see this huge gap and a view gained ground that small and mid caps will deliver higher returns, because that is what you have experienced. And that is what explains the massive excesses or significant excesses in the small mid cap space also. So I think you are right in a way, but over time, this mispricing will eventually correct, as has happened many times in the past as well.
So we are talking about 3 years now, and you're talking about a CAGR 12% return, which means if you're assuming a 12% CAGR return, there are some sectors where you expect that they will have to grow above the nominal GDP or in line with India's GDP. So let's split the market, and I will come back with another follow-up question. First, where do you expect a earnings growth which could be in and around India's nominal GDP for next 3-year CAGR?
So, Nikunj, it is easier to take, it is okay to take a view on earnings which should grow in line with market higher or lower. And I think there I will share with you some opinions. But what we should not confuse is that higher earnings growth need not lead to higher returns, as we have seen time and again. So, if you go back 5 years, utilities were deeply undervalued. What has been the earnings growth? Very low, below market probably. But returns have been extremely high. Similarly, you have sectors, let's say some companies in consumer, which have grown earnings ahead of markets, but the stocks have not done well. So I think as long as you don't extrapolate earnings growth to stock market returns, it is okay. So I feel the dispersion in earnings in this market is going to be extremely low, because the most sectors are making reasonable margins. Still, I feel banks, insurance companies, they should grow earnings maybe slightly ahead of markets. Telecom could grow earnings slightly ahead of markets. Even capital spending, I think, will grow ahead of GDP. The IT, the near-term outlook is mixed. In pharmaceuticals, it is more individual company-led. In consumer, I think mid to high single-digit earnings growth should happen. In automobiles, I think there will be greater volatility year to year because it's an asset which people buy and demand tends to vary year to year. But longer term, I think even automobiles should grow in line with the aggregate earnings in here. Yes.
Now let's look at a pocket where you think the earnings growth will not be there. You think either it's going to be lower or it will get much more lower going forward.
See, in commodities, for example, if metal prices fall, if oil prices fall, earnings could obviously get impacted. But I think markets appreciate that aspect of this sector. But I would say, I mean, in cement, if prices go down, you may not have earnings growth. In automobiles, if in a particular quarter or a particular year demand is weaker, you may not get earnings growth. You may actually even get a degrowth because if volumes are not there. And so I think there could be some pockets where earnings growth is not there, but overall, I think we are quite well placed.
Okay. Prashant Jain believes in one thing: buy cheap, sasta, sundar, tikau. What is cheap in this market? Where is value in the market?
So, fortunately or unfortunately, there is, to my mind, no outlier value in this market. And we have been saying that for a long time. There are sectors like consumer or small mid caps, which I think are still meaningfully expensive. And over time, they should correct. This is my opinion. But if you start looking for deep value, I don't think there is deep value in this market anywhere. The dispersion in valuations. So we did an exercise. We said, let's look at 15-year average valuations because 15-year captures roughly two cycles and compare the current multiples relative to that. So there is no sector which is trading at a discount to 15-year multiples. And the premiums are also confined to just two sectors. I think it is capital goods and consumer discretionary. I think this is a market where it would make sense to run a fairly diversified portfolio because dispersion in valuations is actually quite low.
Uh, I like to shift attention to something very specific, which is utilities. And you've gone on record that you liked power stocks in the past. And everyone knows that this time गर्मी ज़्यादा पड़ेगी, गर्मी ज़्यादा AC ज़्यादा बिजली की demand ज़्यादा. Should one now start taking should one start looking at some of the utilities and some of the so-called power and these safe stocks now because interest rates will come down, demand will be high, and in this volatile environment, power पे तो tariff नहीं आने वाला.
Nitin, you are right that this sector presents growth opportunities to India. And it's, as I said, our AC penetration is hardly maybe 4-5%. So our per capita power consumption is a fraction of the world. So as incomes grow, power demand in India should continue to grow. Now the key is how are you? So growth outlook is fairly steady. It is moderate, but it is fairly steady. It is de-risked. But the key is what are you paying for that? So there, I think the variation in valuations across utilities is quite high. So I think it is mainly a bottom-up approach that one will have to adopt in this sector. I don't think this sector is as cheap as it was 3, 4, 5 years back when it was impacted by either the some tariffs were cut in COVID, which impacted these companies, or because PSUs are out of favor, or because of the ESG challenges. So I think these stocks, again, to my mind, are reasonably valued, and one should expect uh, close to market or maybe slightly ahead returns, but it would be more stock specific.
You have the view that large cap stocks are cheap and small and mid cap stocks are expensive. But is it a good idea to take this kind of a blanket approach? Because there are a lot of large cap stocks which are expensive. There are a lot of mid cap stocks which perhaps have become cheap after this fall. Is it a good idea to have this kind of a blanket view?
You are right. I mean, this view does not mean that every single large cap is cheap, and this view does not mean that every single small mid cap is cheap. When we talk in this language, it implies that on an average, if you take 100 large caps, if you take 100 small and mid caps, that on an average, the small mid caps are more expensive, both in terms of degree of expensiveness and also the number of companies. So I would say probably I'm just throwing a number. Maybe 8 out of 10 small mid caps even today continue to be pretty expensive. And if you look at large caps, maybe 2 or 3 out of or 20, 30 out of 100 or 2, 3 out of 10 are expensive. So it's a relative world, and I don't think one should read in absolute terms in these statements.
I remember we had a conversation, it was just around Diwali, and you said that there are all the telltale signs that the market will peak. Strong price action or rapid price action, buzz and activity in the IPO market, promoters are selling, and lot of liquidity is coming via the FNO route. All those signs have now caused a market shakeout. So you've told us what to look at when markets peak out. Now tell us the other way. What are the signs we should look at which would tell us that markets are nearing a bottom or they're about to bottom out? Because now we are looking at the other side of the pendulum.
See, I don't think we are at the other side of the pendulum. Other side of the pendulum would mean deep pessimism or very, very deep values, which are not there in the market. Now, but it does not mean that you have to go from one extreme to other extreme all the time. It can happen when there is deep panic, like it happened in COVID or Lehman. But I don't think we should compare those times with this. There is some uncertainty, but the impact on India is extremely small. In a way, actually, the external environment, because of fall in crude oil and interest rates, has become more conducive to us. The primary market supply has collapsed, which is positive. So I think the cost of capital in India has dipped. So it would be very hard to say, since we are in somewhere in the middle zone, it would be very hard to say how markets behave in the next few weeks or months. But what I am comfortable saying is if you invest in large caps predominantly or large cap oriented strategies over 3 years, I think low double digit returns are very realistic to expect. And the right way to invest in these markets would be to phase out your investments over next few weeks or 1 or 2 months. And that would not expose you to any higher volatility in the very short term. But at the same time, I would not want to wait for 6 months or 1 year to get invested, because these things, the markets price them in fairly quickly.
That's the point you're trying to make. So I'll be very, very repetitive. This one, my final question, and this is a question which I think everybody, including me, sir, I want to know. If I look at the screen, it is scary. It tells you 2008, 2000, 2020. But the scenario is very different. And we had Dipin Mehta slightly earlier. He said that, look, 2008 also we used the word decoupling. It's only after 6 months we figured out the impact what US market could do. But your view is that this is not 2008. Why is that?
When you talk of decoupling, what are we talking about? Are you talking about coupling of economies, or are you talking about decoupling or coupling of markets? So I think it is very clear that India's economy, I would say, is reasonably decoupled to what happens in the world. And the proof of that is apart from the COVID year, this economy has delivered 4 to 6% or maybe sometimes 7, 8% growth virtually every single year. There is no, even in the Lehman year, we grew 5.5%. So I don't think we need more evidence to convince ourselves that our economy is not meaningfully coupled with the rest of the world. Now, when it comes to markets, what has been observed time and again is that when there is deep panic in the markets globally for very short periods, it could be 1 month, it could be 3 months, these markets tend to fall due to sentiment reasons alone. It happened in 9/11, it happened around Lehman, it happened around tapering, it happened in COVID, and it is happening again now. But since our economy is not impacted, I look upon these falls as to buy the same asset cheaper. The value of asset is not going down. The price is going down. So I think one, clearly this is no COVID, this is no Lehman. We are far better placed. Our current account deficit is running under 1%. When has India's current account deficit run under 1%? The service exports have grown tremendously. Our cost of capital, the gap with US is down to the lowest. So these are far more positive developments than what impact this tariffs or tariff war can have on India. The fall in oil prices is far more positive. So I would not worry about either our economy or the markets, but small mid caps, I think I would be cautious. Yes.
Appreciate your time. You've been very accommodative with this interview request. Thank you for really walking us through the ups and the downs, the market cycles, and your clear emphasis on why large cap offer more value. And this is not the time to really panic. Buy patiently, but don't sit on cash. This is not COVID. This is not 2008. Fantastic. Thank you very much for joining us.
Well, thank you, Nikush. Thank you. Thank you. Bye.
If you like this video, then like, share and subscribe to ET Now.